We are very honored tonight to have Albert with us to join to this live Facebook webinar to share with us on the application of Australia federal tax law and how we can actually manage our income tax as foreign Australia property investors. Albert, it will be a disservice on my part if I don't give a brief introduction of yourself and your business.
You're very kind. Very kind.
Yes. May I have the honor to actually introduce you now?
Yes, please. Yes.
Okay. Mr. Albert Chua, he's a Chartered Tax Advisor Principal and Director of GC Associate. And you are actually based in Melbourne, Australia.
Right.
Now, Albert, you have more than 2 decades of experience as an accountant, tax agent, and a business advisor. And your area of specialty are mainly in personal and business taxations. You also deal with GST and value-added tax matter. Of course, you do accounting. And of course, you provide tax structuring and planning. So, Albert, have I missed out something you would like to add?
No, I think you cover everything. I suppose that it's very, very different as an accountant practicing in Australia compared to Singapore. I mean, because Singapore, you do have, it's a requirement to have the account to be audited, especially there's a company account. In Australia, we probably, it's slightly different from that aspect anyway. But other than that, we do most of the things like any auditors does in Singapore anyway. Yeah.
Sure. But of course, you know, between the two countries, there are differences when you come to the tax law, especially on that is applicable to property. Correct. Now, tonight, actually, our title would be 5 Things You Must Know to Pay Little or No Tax as an Overseas Property Investor in Australia. So may I kick off with the first question?
Yep.
I'd like to ask you, example, if I own a property in Australia, now do I need to inform the tax office?
Oh, okay.
Yeah, upon purchase. Yeah.
That's a very very standard question, as a lot of people will ask me that question. Obviously, that if you have purchased a property in Australia, most likely a lot of your information, your personal information, and the property that you purchase, including the addresses. So all this information be very likely to be captured by the Australian Tax Office, which is basically the tax authority in Australia here. This is because that as part of the process in terms of your purchase, you have to apply for what they call FRB, which is basically Foreign Investment Review Board approval. And there's also a whole lot of other information that you have to pass through the agency. So as a general term in Australia, when you actually file tax return, it's actually a self-assessment process. Okay, it means that you are required to disclose you know, certain information regarding your property in Australia into your tax return, such as how much rental income that you arrive, expenses that is incurred. If you do sell your property, there's a capital gains or loss on the sales. So all this needs to be reported. Now, having said all that, is failure to disclose all this information will result into penalty and also consider the general interest charges if the tax office picks up those information. As you know, in this modern world of technology, there's a lot of data matching they are doing. So they are exchanging a lot of information between different agencies, whether it's FRB, Land Title Office, Land Tax Office, and so on. So you have to be very, very careful when you sort of like deal with all this information, and therefore ignoring it is probably not the best idea. So I would say that, look, information are very readily available by the authority because of all the submission that you have to do when you purchase the property. So therefore, I think it's best that we do this normal thing like what a lot of Singaporean investors does. As my client do, they always file their tax return as required.
Sure, Albert. I also understood that there is this TFN.
Yep.
the tax file number.
Yep.
So is that the first step that we need to do as a foreign investor to
Yeah.
actually apply for a tax file number?
Okay, now the tax file number is not an automatic process. So in order to file your tax return, number one, the first thing that you got to do is to actually apply for a tax file number. Now, tax file number are quite a unique number. It's a 9-digit number that's been issued to individual taxpayer. Meaning that if you have a situation whereby husband and wife bought a property, each husband and wife needs to apply for their own tax file number.
Oh,
So you don't share the tax file number. So individually they got that tax file number. So in this example, husband and wife will have their own individual tax file number. When they file the return, they need to file, say for example, 50% of their so-called their income and expenses into individually their own tax return. Yeah. So that's the normal way of doing things. Yeah.
okay. So irregardless whether the property is actually owned individually or as a joint ownership,
Yep.
right? The tax file number is unique to each individual.
Correct.
Okay.
Correct.
Now, what if I am not a property investor? What if I own an Australian property for residency purposes?
Residency purposes. So you purchase a property for your own use?
Yes.
Yeah.
Do I
So
still
if
need
you,
to?
yeah, so in these circumstances, you probably would not need to have a tax file number for the purpose of filing that property. Now, let me just try to be a bit clearer on that.
Mhm.
If the property that you purchase is for your own use, so there's no income received as a result of that property, and therefore filing of that tax return regarding that property is probably not required. All right, we call not necessary. So, but you still need your tax file number for other purpose, such as you might be engaging employment in Australia here, or you might have a bank saving account where you have interest earned. So the bank will require tax file number. Your employer will require that tax file number for the filing of your, what we call the normal PAYG, pay as you go, pay as you earn income. Therefore, certain tax will be deducted. You still need that tax file number to actually identify you as a taxpayer, as a recipient of that income, and therefore the information will go back to the tax office, and that gets recorded anyway. Yeah.
Okay. Okay. So that's clear.
Mm.
Now, how about most of us? We invest in Australia property as a foreigner. Basically, we are investor. That means our source of income definitely will derive from the rentals.
Yep.
Okay.
Okay.
And the 1 million question that most of us have would be, what would be the ballpark tax rate?
Okay.
Yeah.
Okay. Yeah. So before I go to talk about the tax rate, I think there's one thing very important to. I mean, that's a very good question, Joseph.
Right.
So one thing is very important to understand this is as a, what we call a foreign or a non-tax resident of Australia. Normally, the only income as a foreigner in Australia here you need to disclose is actually your Australian source income. Okay, now, in other words, it's saying that it's income received in Australia. All right. Now, it means that you do not include any income that you derive or receive outside Australia. Say, for example, as a foreign resident in Australia here, you only have income received from the rental property. Say, for example, rental investment property. That is the only income you need to declare. You do not need to declare income that you receive in Singapore, such as your interest that you receive in your bank in Singapore, or your employment income. So that is something that you need to be very, very clear. Now, again, regards to the rental property income, so it's actually a net income. All right. What a lot of people don't understand is they think, oh, look, I receive say $20,000 of income over the years from the property. I need to declare that. Yes, you do need to declare that. Would I be taxed on the full amount of 20,000 as a gross income? Now the answer is no, because there are things that you're allowed to claim as deductions. So therefore, end of the day, you have your gross income, take out all the what they call the allowable deductions or the expenses, therefore derived of this what we call the net rental income. So that is net rental income will be subject to the Australian income tax. All right. Now, you might be a bit worried that if I'm going to give you these figures, because it's quite taxing in Australia. All right. You start laughing already, Joseph, because you've seen this many years. I know you for over 10 years now.
Right.
So unfortunately the foreign resident get taxed very highly. From zero or from $1 onward up to 90,000 is 32.5%. All right. Now it's quite taxing. Now it does mean a lot of things, meaning that you got to be very careful when you actually deals with receiving income in Australia. So you got to learn, a lot of things such as what are the things that is allowed to be claimed as expenses, and therefore I can reduce that gross income down to the level that maybe I don't have to pay any tax, or I pay the minimum amount of tax as a result of that.
Right. Yeah, in fact, you are right. Definitely, we have to apply the deductibles.
Yes.
Otherwise, I mean, I just look at the first $1, as you say, to 90,000 of a source of income. If we were to tax about 32.5% at that rate, so it's almost 1/3.
Yes,
right?
exactly.
1/3 of our gross
Exactly.
income.
Yeah, exactly.
Okay, so the next question then I would like to ask you would be then what are the ways we can reduce and what are the deductibles?
Okay. Look, look. This is I think it's a $10 million question. So rather than $1 million question, look, I think one of the things that we do very well with a lot of our clients is to look at not just the sort of property that they should be buying, and therefore the sort of rental income they can generate. So you always talk about rental property. You always talk about what are the yield in terms of the gross income, coming out from the property, whether it's your 5.5%, depending on where you buy, which part of Australia you buy, and what sort of property that you buy, and what sort of yield that you get. Now, that is pretty much what a lot of clients will start with, when they start investing in property. I believe, Joseph, you do this for many years, 20, 30 years, right. Just dealing with that issue. But I think one of the things that we do very well is we were able to advise the client or give sound advice in terms of what they really can claim. All right. Now, obviously, there's a lot of expenses that deals with the property, whether it is your property manager fee that you have to pay. That is definitely deductible. Okay. There are things that you can claim, such as what if the property that requires repairing? All right, so can I claim the repair because I need to restore the property to original condition so that it can continue derive income for me. So that's something that you can claim, but obviously that's only a small part of it. So what we normally do is that when the client engages, we usually send out a checklist. So our checklists are very comprehensive, and it gives the clients a whole list of, I don't know, there's maybe like 20 or 30 items what you can claim. All right, then there's another thing that we always inform the client is to look at gearing. All right, look at borrowing. Interest expense can be claimed if as long as the borrowing is directly related to the purchase of the property. Then that is something that we always advise client, and we look at how much borrowing that you can have. So we sort of go through that detailed bit with the client. Then we also advise on the client in terms of what you can claim in terms of depreciation, or what you in Singapore term they call building allowance or capital allowance. All right, you can claim in terms of amortizing the expenses of certain assets in the property. Then you look at building cost write-off, things like that. So all these things are considered important to actually get that net income down to a certain level that you may not even need to pay any tax, maybe for the first 5 years if you structure it correctly. So we use the word structure. So structure could mean a lot of things, meaning that when you buy the property, what do you do with the ownership of the property? That's the first thing we look at. Second thing, we'll look at what sort of property that you buy, how much borrowing that you should have, what are the potential capital allowance you can claim, what sort of depreciation you can claim, whether it's down from your air conditioning unit right to your fridge in the house. So these are the things that we looked at. All right. So we compute all that for the client. End of the year, we prepare all the tax filing. So we do all that type of work. So importantly is to plan it out, look at your deductions. So deductions, income, everything's are important, because end of the day, like Joseph had this first title, he said, look, well, how do you reduce your income right up to the level that you pay as minimum tax as possible legally, all right? You know, without doing the wrong thing, all right? Yeah.
Right. Thanks, Albert. I think you are very careful. I like the way you said that we structure, okay, and we pay little or no tax legally.
Yeah.
Okay.
Correct.
So
Correct.
whatever we discuss tonight, whatever we share tonight, is definitely above board.
Yeah.
All right. Something I like you mentioned about depreciations.
Yep.
I think this is not available in Singapore. Right?
No, you know, I think been to Singapore for the last 20 years, doing a lot of this, whether it is to consult with individual client or what I call is those a bit more sophisticated investor, such as the corporate client. We found out that there's definitely different sets of rules in regards to Singapore and Australia. In Singapore, I don't think individually you're allowed to claim this capital allowance. There's no such things. I think maybe for some of the bigger businesses, yes, you can do that if you're in the line of, say for example, buying a whole lot of property rented out. It's like treated like a real business. All those, I think, capital allowance in terms of depreciation on the building or whatever, you can claim that. But I think just the normal person in Singapore, you know, a bit like us, that's not available. But in Australia, the rule works slightly different. I think this is one of the things that it's good to talk about it tonight. Is Australia, they don't, how do you say, it's one rule for all. All right, so there's no special rule for certain person. If you buy property in Australia, if the rule says that you're allowed to claim, so whether you bought it under the company, personal, everything, the rule is the same. Yeah.
Okay. All right. And then come back to the depreciations. What do we need to do to actually apply this depreciation? Is there a schedule that we can apply?
Yeah, that's a good question, Joseph. I think for all this year, a lot of people have this misconception and say, look, wow, you know, if we buy a property, definitely there are things that we can claim. Yes, there are things that you can claim, but how do you quantify that value? I think that's very important. As you probably know, when you bought a property, there are probably a couple of components in it. So the way I break it up is I look at the property and say, wow, there's definitely the land component. Then you have the building component, and you have the fixtures and fitting component. And then the other thing is that definitely that the developer has to have some margin in it. All right. So the whole thing will make up of all these four components. Now, definitely, when you look at the developer margin, you can't do anything about it because that is the profit of the developer. There's no depreciation benefit for that. Land is definitely not depreciable. So it boils down to the two parts of it: is the land, the building itself, okay, the building cost, which is basically the structure. Then the other thing is all the fixtures and fitting inside the property. All right, now that requires a bit of work in terms of quantify that value. All right, now over the years, there's a lot of argument and saying, look, wow, you know, effectively, you know, you and I can do all these things because we know how much it is. Not really. The tax office sets out quite strict rule in terms of how that's going to be done and how that's going to be quantified. Now, we have rules to determine who can do that. Definitely not a tax agent like myself, an accountant, tax agent. We're not allowed to do all these things. I think, you know, the other issue other than not being a proper qualified person to provide that sort of value advice, you really need a proper valuer or what they call a quantity surveyor to do that. There are tax rule that requires that to be done under a certain format, and it has to be signed off. So at the same time, not just the building value, the quantity surveyor has to be also a registered tax agent for the purpose of preparing that tax depreciation report, or they call tax depreciation schedule, in order to provide that. Now, I have a lot of people asking me that's fine. So how much does it cost to do all that? All right. So the $10 million question comes and say, okay, look, do I have to do a couple of questions? First thing, I know I got to get a quantity surveyor to do it. How much is it going to cost me? First question. Right. Second question is, do I have to do this every year? Do I have to pay this guy to do it every year? Now, the first question is, it's actually not going to cost you a lot of money. All right. All right. So I think to be fair, we actually work very closely with a lot of quantity surveyor.
Right.
We have actually a panel of 10 of them. So we pick and choose, but we do work with only, not exclusively. We work with a few good ones. Okay. I think we need to be, it has to make sense, right? The cost is always an issue for investor. All right. Now, we were able to negotiate a fixed fee for most of the tax depreciation schedule or the report. Now, anything ranges from $400 to $500-$600. I think if I quote anything between $450 to $500, I think that's fair. Sometimes
very reasonable.
Very reasonable. Sometimes you have very good deal that they do a bulk discount, because we might have I don't know, 20, 30 investor buying property in one tower. They were able to do it for $330 per report. So that was pretty good deal. So we usually tell clients, look, come to us. We will have other clients who have bought the same property. That is, I think, the discount that you can have. All right. So it's basically a discounted report. Now, do you do it every year? The answer is no. So it's a one-off. All right, a one-off, and the report should last you for 40 years. All right, you don't have to do it again. It's not an every year thing. It doesn't cost you $330 every year or something like that. It's a one-off thing. All right, and it lasts you for 40 years. That's all you do. Yeah. All right. So if anybody rocks out and say, look, wow, we can offer you a service for $500, and you got to do it every year, or the report is, say, I've seen it many times, QS prepare report, 10 years. And I said, look, where's the rest of the 30 years? All right. So why I use 40 years as a benchmark is because building depreciation is 2.5%. All right. So 2.5% is 40 years. So the report should actually has 40 year worth of tax depreciation value inside the report. And it's not a one pager. All right. People often get flogged with a one pager. It costs them $300. Every year they have to pay for that. I said, no, you don't accept report of a one page. A proper tax depreciation report should be 15, 20 pages long, get signed up by the QS. All right. So that's very, very important. Yeah.
Wow. One report lasts for 40 years.
Yes.
Yeah, I don't think
your money is worth.
I don't think sometimes we hold that property for that long.
It doesn't matter anyway.
Yes.
So I think it's just value anyway. I mean, you know, we understand a lot of clients come to buy property in Australia. They feel that sometimes they've been ripped off because of all the wrong advice. We should usually tell the client, look, don't listen to anybody. Just listen to the right people. At least listen to Joseph anyway. Yeah.
Listen to Albert, very important. Tonight we actually answered a lot of the myth, right?
Yeah.
The myth about this depreciation schedule.
Yeah.
Okay, it only costs you about $500.
Yeah.
That's about it.
Not more than that.
Yeah, not more than that. And the next 10 million question is, can I file the tax myself? It looks like it's quite tedious. And of course, most of the listener or the webinar fans here will want to know, what is your fee if they engage you?
Okay.
Yeah.
There's a lot of answers that I over the years, I've been doing this for the last 20 years, since 2000 in Singapore. I've been in and out of Singapore, as you probably know, in your previous role with other agency. So what we often get asked is that, can you do your own tax return? I say, look, definitely you can. All right. I think our tax office is very, I shouldn't say friendly. I would say they welcome people to do their own tax return. But I think they also been a bit cheeky in a way. I hate to say this. They tell you can do it yourself, but they didn't tell you that if you get it wrong, how do you fix it? All right. So as you probably know that I tell you this earlier is we have this system called self-assessment. I think the issue with self-assessment is that you report what you think is correct. All right. Now, we tend not to do that with our client. We tell our client, you got to do it correctly, because if you get it wrong, self-assess means you got to submit it yourself. You got to report what you think is correct. As a background, as an accountant, all right, and more often, we do a lot of tax audit work as well. When you get it wrong, when the tax authority come, they want to go through the record and they picked up there's a mistake, they're going to ask you, all right, why you make that mistake, all right? Now, if genuinely is a mistake, that's fine. If they feel that, look, it's not genuinely a mistake, then you're in a lot of trouble, all right? So then the level of penalty would apply. Then it goes from 20%, 25%, 50% penalty, 100%. It means that if you short pay by say $5,000, the penalty could be 25% of that $5,000 on top of that you have to pay plus interest, and it could be 100%. All right. So I'm not saying this just because I want more business. I think our service and our advice to our clients have been very, very good over this year. We always tell the client to do the right thing. All right. So you can do it, but you just got to be careful about it. Now, that is one part of it. The second part is obviously the deadlines are very important. Okay, the timings are very important. Now, if you're going to file your own tax return, you're welcome to do it, and you got until end of October to do that. All right. So it means that 30th of June cut off one financial year, and you literally got 4 months to do that. All right, and people got a million things to do. All right. Because we make $1 million, right? So we got a million things to do. We tend to forget about it. Then 31st October come, we're too late. All right. Now, submission after 31st October by yourself, it will be subject to penalty of some sort. All right. That's considered late. All right. Then the alternative is to come to us as a registered tax agent. There's plenty of registered tax agents. We are one of those typical ones, but it just happened that we in this market, we deal a lot with our client in terms of similar scenario. As a tax agent, we're not just getting extension, so we have the knowledge how to deal with issue. Now, the other thing is interestingly that we talked about this yesterday is what if you have more than 1 year of tax return you haven't done?
Oh,
right. So we're back to that. We're back to that. I'm not sure about $10 million question. Is the $5 million question is, what if I have 5 year of tax return I haven't done? Is it too late to do it now? Okay. Where do I start? How do I do it? All right. So when you do self-submission, effectively, if you're 4 months behind, you're late anyway. All right. Not to say 5 years, you're totally late. Right. So you got to deal with that strategy issue in terms of dealing with the tax office, because when you call them up, you could be on the line for about an hour, you still don't get an answer. Or if you have a question, you call them up, you don't get an answer like you can get it from me straight away. You have to wait, right? And if you call 3 times, you're most likely going to get 3 answers, all right, or 3 different answers, all right? So as you know, right, that's how they work. Okay, so again, you can do it yourself, but just be very careful and watch out for the time and do it and do it correctly. All right. Yeah.
Yeah, Albert. What about your fees? Because
My fee. Oh,
yes,
okay. That's $1 million question. All
yes,
right. Look, we operate for a number of years now. Joseph, you probably know,
yeah,
we deal with our client. We have a very standard fee base. We charge a fee for handling the tax phone number application. That's a standard fee of $150 per application per person. So if you have a husband and wife situation, that is $150 by two. So it's $300 just to deal with the tax phone number application.
right.
It is getting a bit more difficult in terms of getting those things sorted out. I mean, they're quite strict in terms of verifying the person. So we do know the whole process inside and out. You know, what documents you should supply, get it right. All right. So it goes in. Nowadays, it doesn't take 30 days to process. It takes 3 months. All right.
Wow.
Okay. So it takes longer. And then they do a
Takes
lot of
longer.
checks. They do a lot of checks nowadays. They check, make sure that, you know, your passport is still valid and all these other things, right? Yeah, and they need that documents to be properly certified by the so-called the Australian representative, being the Australian consulate or the High Commissioner of Australia in Singapore. Then we do have a standard fee in terms of how much we charge to handle the amount of property per person. All right, say for example, typically a single person with one property, annual fee is about $300. So if you have a husband and wife, two individual tax return, but commonly own one property, 50-50 split, so that is $450 we charge. So that's the sort of fee that we charge, right? Been doing this for so many years. I don't think our fee has actually increased that much over this year. I think it's all about, you know, giving the client the best service. You know, those fees that I quote is inclusive of all the tax advice you can get. If the client, you know, calls me up and say, look, well, you know, Albert, or send me an email and say, look, Albert, I need some advice in terms of, you know, purchasing the second property, look at the structure issue. There's no additional fee doing that. All right, I'm happy to pick up the phone, call the client, WhatsApp, whatever phone call, give them some advice, how they should look at. All these are free of charge. There's no extra charges for giving advice if you're already a client with us. Yeah.
Okay, Albert. For $450, definitely I will use your service because
Thank
I
you.
don't think it's worth it for me to spend my time,
Yeah.
right, to do the assessment myself, which is sometimes, like you say, we probably prone to mistakes. Okay,
Yeah.
and we might not be filing our return properly. All right.
Yeah.
So same thing. I think whatever service that we need, we should go to a professional one, and we should do it properly. And
Yeah.
then we avoid all the pains, you know, of later on having to fix the issues.
Yeah, I think that's quite correct. I think
Yeah.
one of the things that we found that I mean, this is not not something you need to be worried about if you're doing all the right thing. We found that if the client hasn't been really consistent in terms of reporting, or hasn't been really consistent with the data they report, I mean, just openly speaking here is that the tax office does keep a lot of records, and they do a lot of data matching, and they do a lot of what we call trend. All right, so they look at, you know, the sort of suburb that you bought your property, the sort of property that you have, you know, whether your rents are correct, whether your deductions are correct. So all these are considered. They're doing a lot of analysis on that. So I think we're very careful. You know, we don't just, you know, pick the information blindly and just put it in and just forget about it. You know, we don't do all that. We actually, you know, took the time, like an accountant, prepare a proper account for the client in terms of, you know, pulling information from their bank statement, rental statement. So we had to do all that work in order to put the information in front, all right, of the client and say, look, wow, these are the correct information that goes into the tax return. Because end of the day, when it gets picked up for a tax audit, we will have all the information to basically defend the client, or we'll be on the front line, you know, speaking on behalf of the client and say, look, wow, these are the correct information because we have done all that. So I think that says a lot in terms of us protecting our client's interests. All right. So importantly is, you know, as you probably know, you're like 2,000 miles away or something like that. You bought a property in Australia. You just want to make sure all the information file are correct. You don't want to go into, you know, checking through everything. You want to make sure that you entrust, you know, an accountant and a proper tax advisor to do all these things and all the information correct. Yeah.
Well, definitely. Thank you for the explanations. And really, I can feel that really there's a lot of peace of mind.
Yeah. Thank you,
Okay,
Joseph.
there is a question that comes in from Floor. Okay, Floor asks, what if you initially bought the property for own use, then switch to an investment in a few years' time?
Okay, now I must congratulate Flo for this very good question. I think there's a couple of things that you need to be very aware of when you actually buy property for on use in Australia. I think one of the things that two main things that I would take consideration of is, number one is those times that you had used the property for on use, we call buy property for the on use, there are no capital gains tax implication on that. All right, so it's very important to note that. But recently the rule have changed a little bit in terms of that aspect. All right, say for example that Flo might have a property for the last 10 years. Normal rule is that if you kept the property for your own use, say for the first 5 years, all right, and then subsequently the second part of 5 years, you actually rent out the property. So you can actually work out, you know, what a potential capital gain issue, okay, and therefore what is considered taxable, what is not considered as taxable for capital gains purpose. All right. Now the rule has slightly changed a bit. Maybe if Flo is interested, can get in contact with me. We might be able to, you know, share a bit more detail on that. Rule have definitely changed as a result of that. In particular, as a foreign investor or foreign owner of that property, the Australian property. That is one aspect of it. The other aspect of it is to look at the income declaration issue. All right. So what she needs to declare or what doesn't need to be declared. Definitely that, you know, the first few years that you have been using the property for yourself, there's no income so-called derived from the property. So there's no income tax implication of that. But subsequent of that, there will be, because they were receiving income. So you need to really report the income. Now, then you also face with a lot of other complication in terms of what if I have a loan? What if I have a mortgage loan? All right. So what happened to that mortgage loan when I start renting out a property? Am I able to get tax deduction for the interest? So the question. What about the depreciation? Can I claim or not? So these are the things that we will look at for the client. Over the past few years, we do have a lot of clients like this. They are more concerned about the capital gain issue, because that rule have changed a lot over the years. All right. We normally tell the client that every year you get an update from your tax advisor. You should really know your position. Okay. When to buy, when to sell, and when's the right time not to do certain things. When's the right time to do something. All right. So these are the sort of planning aspect. We can help anyway. Yeah.
Thanks, Albert. I hope, Flo, your question has been answered. And I think you posed another question, but I'm not too sure whether Albert is in a position to answer. All right. Yeah, Flo asks, is this a good time to buy Sydney properties now? Many friends said that the prices have dropped a lot.
Oh, okay. I think that's a property question. All right. Now, that's a real property question. That is a market, more or less a property market question. Now, I can try to answer. I think the issue with me answering it is I draw a lot of experience looking at client purchasing property in different so-called different city in Australia. All right, so I have client on the East Coast, from all the way from Surfers Paradise right up to Sydney. Then you move down to the south, you're in Melbourne, then Adelaide, then you go over to the west in Perth. I do have a few clients bought in Northern Territory in Darwin. That's not doing very well. I think the issue with purchasing property in Sydney is you got to be very aware that the price is still quite high. Yes, there is a drop. People are talking about it. People were talking about it. Oh, there's going to be a 30% drop. Trust me, there will never be a 30% drop. Okay, and you always have to be very careful when you buy Sydney property. Prices is right up there. All right. I don't know about you, so I think one of the key questions you need to ask is that what are you buying? Where are you buying? Is it close to public transport? I mean, Joseph, these are the $2 million question. Is
Right,
it
right.
are you buying the right property? All right, are you getting the right rental? Do you get access to capital growth? Do you get access to depreciation? Can you borrow? All these are a complex question. So it's not, should I buy Sydney property? So I think in general, most property in Australia, it's worth considering. But again, like a property person, you should really look at what you should be buying, whether all these other things such as, key question is, do you want to pay full cash for the property? I mean, is that full cash returning you a yield? Is it a 3% or 3.5% with capital growth? All these questions, I think, needs to be looked at correctly. Yeah. Sorry, I didn't answer the question, but that's the best answer I can give.
No problem, Albert. I think you have, well, in fact, Flo said it's a good advice from you.
Thank you.
Okay, Flo, if you, I don't know whether you have joined our Facebook group. If not, you are strongly encouraged to join. We can actually discuss this property purchase, right, in the Facebook group, because both myself and Kenny, all right, we kind of able to share you how, all right, what are the framework you should be looking at when you have if you are interested to acquire a property in Australia.
Yeah.
Okay.
I think that's the right way to approach it. Yeah, Joseph.
Very
well done on that. Yeah.
Okay, Albert, I have another question here.
Yeah.
For tonight, in fact, this is the last question I have for you.
Oh, last question.
Yes.
The golden question.
Golden question. I think this could be the toughest question.
Oh God.
Right? But I'm sure you can handle that.
Yep, sure. I'll try my best.
All right. Okay, I think a lot of us want to know what is negative gearing, and how do I negative gear my property? Because I'm sure some of the people out there, they have never heard of, can negative gear my property, man?
Yeah. It's a very interesting thing, but I'm not too sure whether you're aware that negative gearing has been in Australian property investment since 1980 something. So that's been going around for a long time. So it's not a new concept, all right? But I think a lot of people don't understand it is because they feel that we only talk about it, but how do we actually put it into practice? All right. Now, I think first of all, people need to understand the definition of negative gearing when they deal with, say, Australian property. All right. Now, negative gearing is just a way to describe a situation whereby the expenses associated with that particular asset or investment, in this case, are actually greater than the income generated by these assets. Now, if I can just put it plainly, is effectively it's expenses more than income. All right. So you create this effect called negative income. All right. And therefore you pay no tax. All right. Now that's very good, if you can really do that. All right. But people often say, look, what's the point of doing this? Now in Australia, it's very, very, I would say it's very, very common. I think that's the wrong word. I think everybody does it. All right. Everybody does it, but I think there are people there who do it very well, and there are people who does it very lousy. All right. Now, when I say lousy, it means that they don't understand. They don't understand why they're doing it, how they're doing it. Are they doing it effectively? All right. Now, there's a bit of trick of talking about this and doing this.
Okay.
Now, when we look at clients that are very high income, all right, say for example, I shouldn't say myself, but I'll use myself as an example. If I say I earn a package of $200,000-300,000 a year in income, all right, if I go and do this negative gearing, I would generate negative income out from my investment property. So say for example, my first investment property can generate $10,000 of negative income. So I'll reduce my total taxable income by 10,000. So if I'm on a higher tax rate, imagine that if I'm on a higher tax rate, every dollars that I save or every dollar that I reduce by taxable income, I'll be able to save 45 cents in $1. All right, so that's been the higher tax bracket. Now, that is all good for me. All right, then when people hear about this as overseas contacts, say a foreign tax resident in Australia, okay, say from Singapore, they want to buy property. They say, hey, I want to do this as well in terms of negative gearing. Can I do this? So I'm actually very careful when I explain to a foreigner buying Australian property and try to do this negative gearing. Now, it can be done, but you got to know how to do it. All right. Now, I'll give you one example. I have bumped into a client and said, look to me, he said, look, wow, you know, Albert, you know, as a Singaporean, we always buy property, you know, like to pay full cash, right? This guy is 75 years old, all right? He said, look, you know, what's the point, you know? My money in the bank is not earning well, you know, I might as well take the money out and buy property, you know? So I bought 2 properties so far. I pay full cash, all right? So I got all this income coming in and I got no deductions, especially borrowing. You know, he doesn't have a mortgage, you know, you can pay a bit of expenses here, you can get a bit of depreciation benefits. So effectively, I don't have a loan, all right? And therefore, I don't have a negative income because I don't have deductions in terms of the mortgage interest. So I've been paying tax all this year. You know, 2 property, you know, I might be paying 10,000, you know, $15,000 of tax, positive income. So look, I got this idea, you know, I want to negative gear for my 3rd property. All right, can I do it? I said, that's a fantastic idea. You should be doing it. Now, it's very easy to say and done. All right, now, because I understand his situation is this. He bought the first 2 property under his name. All right, now, the guy is married, but he said, look, you know, I want to buy this 3rd property, but I want to buy under my wife's name. And I said, look, that's not a good idea. You know why? Because the negative income from the 3rd property, meaning that the expenses more than the income equal to negative income from the 3rd property, is actually flow to the wife. All right. Remember, I talk about you know, individually you got your own tax number. So the account of that 3rd property is actually belongs to the wife. All right. She gets the negative income, and it cannot flow back to the husband. All right? The husband owns the first 2 property, no mortgage, positive income, he cannot offset. All right, so effectively he's done it, but no impact. All right, so what she should have done is to buy the 3rd property under his own name, his personal name, so that the 3rd property negative income can flow back to offset positive income for the first 2 property. So that's how you do it. All right, now it just, unfortunately, that is the rule. So you got to know the rule and know how to structure it. Now, the word is structure again. So we do a lot of this type of work. You got to know the rule, structure it so that you flow through the effect of negative gearing into that. Now, especially it's quite important for foreigner, all right? Because there are classes of income you can match or offset, but are there classes that you can't do it? Right. All right, so that's how you explain it, you know, in the simple way. Yeah.
Right. Thanks, Albert, for the explanation.
No problem.
I think this negative gearing is really very interesting.
Yeah.
And I am sure some of us out there will be wondering, wow, is it possible to accumulate a negative gearing?
Yeah, definitely you can. Yeah, that's one of the things that is even more interesting you have that negative income, say for example, from the example that I given you,
Right.
the third property could be the first property for the wife, all right, and she can accumulate the losses, you know, indefinitely, so she wouldn't lose it, all right. And if the property turn around in say 5-6 year time, it become positive gear, it can actually use the previous year losses to offset the income, and there's no tax payable. People like to hear that I don't have to pay any tax. People loves it when they hear that.
Right, right.
Yeah.
And definitely, because if let's say we were just to put in the all the deductibles allowed, plus I think the big ticket is the depreciation value.
Yeah, correct.
Right.
Correct. I didn't have the chance to show you this. It says you probably seen this before. Over the years, I do updates a lot of the what I call the information or the data that I receive from the tax office. Presenting on a year-to-year basis is to look at what information the tax office has collected from the individual taxpayer, and as a whole, what component of the total deductions are so-called interest costs, what are the depreciation. I think just you know, on top of my head, I mean the interest, talk about borrowing, interest cost, borrowing is about 49% of the total expenses. Depreciation is another 14 to 15%. So if you just look at these two items, you're already talking about 65% of the total deductions. So if you're not even focused on that two component or the two deductions that you should be, I think people are not investing it correctly without, you know, utilizing what the law allows you to do. All right, we're doing this legally, right?
Right, exactly.
Yeah.
So the biggest, the two biggest component is the interest and the depreciation value.
Correct.
Right.
Yeah.
I guess some years ago I did the worksheet, and the depreciation value can work out to be about I mean, starting from the first year, it can be something like 12,000, right?
Yeah.
About 10,000.
It all depends on the type of property. I mean, while we're still on the same topic, I mean,
Right.
you got to look at. There are many examples that floating around and say, look, wow, you got to really go to the right source and say, look, wow, if I got to buy this property at this price, typically what sort of, you know, depreciation I can claim. Most I think most project or most developer will provide the first-hand information, and you do not accept for less. You probably will ask them, say, look, well, you know, can I get your quantity surveyor of your valuer to provide that in the schedule? I think they're more than happy to do that. It's one of the tools that they use nowadays to entice property investors. I mean, I look at it, you know, on the day-to-day basis. I mean, you can tell straight away the sort of property that you buy and the sort of benefit or the tax benefit you can claim, and how, you know, in terms of value over from year 1 to 5 years to year 10. The overall the 10 years, I mean, usually people will keep it at least for 10 years property. Then they'll dispose it. You know, you were right talking that, look, you know, people might not hold on to the property for so long. But I think over time, I tend to have more property investor who holds property for a long time, for long term. Nowadays, I have, you know, investors hold on property for 20 years. They don't sell it. If they sell it, they like make a couple of $100,000. I mean, that's all worth it if you're going to do it properly. Yeah.
Thanks, Albert.
No
Yeah, I think this is a very good insight into negative gearing. Can I ask you one last burning question?
Oh, burning.
Yeah.
Sure, no
well,
problem.
It just came into my mind about this thing called capital gain tax.
Oh, okay.
Yeah, because in Singapore we don't pay capital gain tax if we sell after, you know, after 3 years.
No. Unfortunately, that doesn't work in Australia here. I mean, we do have a lot of rule changes in terms of people. I won't say people. I would say some investment scheme being structured try to get away from capital gain. I mean, it's always been caught up. I'll give you one example that people think that by putting the property in or structure that who has core assets in property, deemed not to be capital gain. That's not quite right anyway. In actual fact, you know, as soon as they talk about that, then the new rules comes in and say, look, wow, no, you know, certain disposal or certain investment assets, if the assets class itself got more than certain component of property, and therefore the capital, the so-called the gain will be classified as capital gain because it's got property. Unfortunately, capital gain has been around, you know, in Australia since what, 1985. We brought in the rule in I think it was 19 September 85, if I can remember that correctly. Correct me if I'm wrong. But pre-85 assets, okay, there's no capital gain on that. Post after that, unfortunately, yes. All right. And Floyd mentioned early on about, you know, assets being used partially for private use, partially for investment. So that part will also have some capital gain tax implication. Now, in relation to investment property, if all the while the investment property is considered as a capital assets, you know, meaning that they use the assets to generate income, therefore any gain as a result of buying and selling of that capital assets will have capital gains tax implication. All right. Now, it doesn't mean that you always have to pay more tax as a result of that. This is where people get it wrong. You need to understand, you know, the sort of the nature of the capital gain. All right. Now, we used to give also away. I mean, I'm actually everywhere at the moment, but I just hope that I sort of give people a little bit more sense of like a sort of normal understanding of that is they are capital gain, but they are also capital gain discount. And it means that you don't pay tax on certain capital gain. People need to access all that thing. Definitely the earlier example in terms of partial capital gain, it's important. You need to separate that. There are ways to reducing it, all right? But you also need to understand that people would need to also understand they can access some sort of capital gain discount, all right? Used to be up to, I think up to 2012, people have investing in Australia for the last 20 years. So definitely up to 2012, they stopped this capital gain discount. But it means that any valuation or any assets pre 8 of May 2012, they still be able to access the 50% discount. So anybody interested in that, I can sort of like explain a little bit more, or maybe look at their real scenario and try to work out what are the things that they can do. So these are some of the things that you need to look out. And then the other thing is to look out is also there are people who have multiple property. Some year, not everybody sell property will make capital gain. All right, there are people that who sold it and said, look, wow, you know, I have allowed, you know, I bought a poor assets that did not perform. All right, so I've sold it many years ago, maybe 10, 20 years ago in Australia, and I make huge capital loss. So recently I bought something and I make a capital gain. So what happened? Can I pull back the old capital loss to offset that? So these are the things that you need to look at. So what you try to do is to try to minimize the net capital gain position. All right, so I'm just talking in general. So if I want to be specific, then I could look at the example and say, look, wow, okay, this is what you have. You bought this property the last 15 years. Up to a certain year, you can do this. Up to a certain year, you can do that. Yeah, so I can sort of like tailor that situation for that person. Yeah.
Well, thanks, Albert. Well, thanks for the answering my last burning questions.
No problem.
You have been very, very you have been sharing a lot of insight with us tonight. So we have come to the end of this webinar tonight, and really, on behalf of the team, we really like to thank you for your time, all right, and for your generous sharing, I must say. And
no problem. You're welcome.
And for all the fans and members out there, especially for the fans or for the public who are hearing us, who are joining us tonight, if you have not joined our Facebook, please click the link, our Facebook group, pardon me, please click the link and join us. All right. And if you would like to follow up with some question or some burning question that you have for Albert, all right, we'll put his contact, we'll provide you his contact in the Facebook group. And I'd like to give back to the host here, Yiming.
Okay, thank you so much once again, Albert. Thank you so much for sharing. It's a definitely very good learning experience. So yep, I think that's the end of the session. And of course, as what Joseph has mentioned, do join the Facebook group. I have actually put the link in the group chat in Zoom and of course in the Facebook comments as well. Okay, so if there's no further question, really thank you everyone. I think
Thank you.
that's all we have, and see you all again very soon.
Yeah.
Okay,
Thank you, Albert.
Good night. Good night,
Thank you,
everybody.
everyone.
okay, good night. Bye bye.